It would seem it's a big boost for the Indian money markets because now Bloomberg Index Services is going to include the Indian sovereign bonds in their Bloomberg Emerging Markets Local Currency Index and the related indices. It's going to happen in a phased manner from the 31st of January 2025. What are the implications? How is this process going to be done? Anurag Joshi, my colleague, is joining us with that information here in the Mumbai newsroom. Anurag, walk us through it.
Bloomberg has become the second financial index provider to include India's bonds in its debt indexes. So Bloomberg will include the Indian government bonds in its emerging markets local currency indexes, and this will be from Jan 31, 2025. Now, the inclusion of Indian bonds will be phased out over a period of the following 10 months, and by November 2025, the full value weightage of Indian bonds in the Bloomberg indexes will be added. Now, JP Morgan had decided to include Indian bonds in the debt indexes in September last year, and the JP Morgan's decision to include Indian bonds had led to forecast that about $21 billion would come into Indian debt markets through that move alone. So the weight of the Bloomberg, the inclusion in the Bloomberg indexes will be increased by 10% every month. This will be until October 2025.
That's right. By the January of 2025, we can expect that entire process to start of the listing of sovereign bonds of India. And this is happening after JP Morgan has also listed Indian sovereign bonds. So what are the implications over here? For that, Hemant Mishra, the co-founder and CIO of S-Cube Capital, is joining us from Singapore. Great to have you with us, Hemant Mishra. The kind of upsides in inflows, foreign inflows from investors, how do you see that happening on the back of this new inclusion after JP Morgan, its Bloomberg Index for emerging markets, where we are seeing this happen? And I ask you this specifically because FII ownership of Indian government securities has been significantly lower than our peers in the emerging markets. It's been at 2 to 3%. So how significantly do you see that changing? We're still playing with forecasts here.
Hey, good evening, Vikram. Always a pleasure to be on your show. So today's announcement, in some ways, we'll look at this as a movement and not a moment. It started with JP Morgan, and now we've got the Bloomberg news coming in. And in our expectation, FTSE Russell should follow in the rest of the year. Clearly, today's announcement is not as big as the JP Morgan Index announcement, for the simple reason that it's a much larger AUM that particular index tracks. But when you look at the aggregate of JP Morgan and then Bloomberg, and eventually when FTSE happens, as per our own models, India will see around $45 to $50 billion of inflows over the next 12 to 18 months. Now, the implications of this, which was your query, Vikram, happens at three levels. The first is at the fiscal deficit level. If you look at some of the rating companies, they've always expressed some bit of a concern on the government's budgetary deficit and the ability to finance it. Now, clearly, with an additional liquidity pool, which is foreign in nature coming in, it will help finance the government's deficit and will also reduce the cost of borrowing because the government can now borrow at a lower rate because there is more demand than there has been in the past. So that's the first impact. The second impact is, these are hard currency flows. These are hard dollars coming into the system and coming into the country's foreign exchange coffers. So that helps our current account deficit. Our current account deficit anyway looks good, at 1% of GDP. It's a fairly healthy number. But the incremental $45-50 billion will help India. If we need, we can import more, or if we need to kind of demonstrate a lower current account deficit, or if, God forbid, if oil goes higher with the Middle Eastern crisis, our capacity and our insulation buffers go higher. Our shock absorbing capacity goes higher. So that's the second positive. And by extension, it will mean a more stable rupee. Now, a lot depends on what the Reserve Bank of India wants to do. And my guess would be they'll not allow the rupee to appreciate a lot. But gone are the days when the rupee was always seen as a declining currency. Often when I meet foreign investors, they will normally discount a 3 to 4% depreciation in the rupee. I think that's bound to change, not only with this flow, but the structural upgrade that's happening to the Indian economy. So in nutshell, fiscal account deficit looking good, current account deficit looking much healthier than it has ever been, and a stable rupee. Now, at the micro level, what this means for companies is, a big part of the government's borrowing, around 20%, will be met by foreign institutional investors. So the banks have capacity to actually lend more to the mid and the smaller Indian companies. But that, I guess, will happen over a period of time because the transmission effect, Vikram, takes a bit of a time.
Yes, absolutely. So there is that lag when we're talking about private sector capex. It hasn't grown at the pace that the government has been spending, and that's where we're likely to see a change happen. But you did mention this dollar inflow. If there is a strong dollar inflow on the back of this inclusion of Indian sovereign bonds now, how much strength do you actually foresee coming to the Indian rupee? Because you said that the RBI will try and see that there isn't too much of an appreciation. Well, what would be the comfort level then?
So the exchange rate policy, the way it works in India, is a bit different from how it works in the other countries. So in India, the Reserve Bank of India uses what is called the real effective exchange rate. And they have two indexes that they track. One is a broader index and the other is a narrower index. But they have a band around what they think is the mean value of the exchange rate. And they'll never allow it to over-appreciate or depreciate significantly outside of that band. Now, not in the past, if you analyze it, that band is anywhere between 3 to 5% around the mean value. At this point in time, the rupee is fairly valued. So they could allow it to appreciate a little. But I think they'll be against a substantial appreciation despite the significant flows coming in, because that will throttle the export competitiveness of the country. And it just doesn't make sense to get capital into the country while on the current account, not be in a position to export as much as you would want to. So my guess is not too much of an expectation, but that's not the point. To me, the biggest point is the 3%, 4% depreciation that you've seen over the past decade and all. Now that's ruled out. And when I look at it from a foreign institutional investor's point of view, whether they're investing in bonds or equities, that's a delta that they've not seen in the past.
When you look at the kind of traction that the bond markets could get on the back of this, the kind of rub-off on the equity markets, how do you foresee that?
So the bond markets today, if you looked at it, did not rally despite this news, and the reason for that was twofold. One is, in some ways, this is expected. And in fact, when I met up with Anurag, when I was last in India, I did say that we're expecting this to happen in the first quarter of 2024, and the FTSE to happen later on, because they normally there's a significant lag by the time they act. So the bond market reaction, I think, in some ways is dusted now. What you're seeing is the active managers are already putting in money. So over the past 4 months, you've seen around $4 billion of money come in Indian bond markets. And this is leading the passive investors who will only start investing once the JP Morgan flows start coming through the passive indices. So in many ways, I think, that particular flow is discounted in the price. The bond markets and through the transmission effect onto the equity markets will now be looking out for guidance from what the Federal Reserve does and what the RBI does.
Right.
More the Fed than the RBI. But when the flows actually happen,
yes,
that's when you might see some bit of a rally, but a lot of it is actually priced in.
Right, fair enough. Hemant Mishra, it's such a pleasure having you on India Tonight. Thanks so much for making the time and joining us from Singapore.
Thank you.
Meanwhile, we are tracking